Hey, good morning, everybody. It's Hammer. Today is Friday, June 6th, 2025. I, of course, am here to talk to you about what's going on with mortgage rates and pricing. Today, we've got an exciting day. Today, we're going to go ahead and talk about what happened with BLS jobs data, all the headline stuff there. What did the numbers come in at? What does it mean for mortgage rates today? And as we roll further into next week. We're also going to talk about what's coming next week. Spoiler, we got CPI inflation data, but we'll talk and see if there's anything else that we actually care about and what we think is coming into the rest of June. I mean, what good is forecasting if we can't forecast, right? So that's what we're going to go into today. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. If you're here this morning, say good morning. Like James Mahan, Mike Morano, good morning, y'all. Randy Teagle, giddy up, sir. Mike Brown, good morning. Deb Dickinson. Mike Morano said, how's Tag? I don't know, dude. I was working from my hotel room. I don't really I don't really care about the speakers. Jordan Peterson talked yesterday, and I was bored. I've seen him on Rogan's podcast and liked him there, but man, 90 minutes of Jordan Peterson was a lot. And the first hour, he was just kind of on his own, and I don't know. ADD kicked in for me, y'all, and I don't know. So, I'll head over there at lunch. Otherwise, I'm here with y'all. And right now, this morning, I would like to see Jesse this morning, but I'm going to be with you guys. And by the time I get over there, it's at the stadium. And although it was a really cool idea to do it there, it's noisy and hard to hear and do things. And so anyway, so I'm here in my next quiet room talking to you guys. So if you're here this morning, say good morning. If you're watching the replay, go ahead, give me a hashtag replay in the comments. Let me know that you were here. Let Facebook and YouTube know that you were here. Smash that like button, tag an LO friend, share the post in a group. You know all that. Remember, if you want a reminder that I'm going live, you can get one. Sign up, hmmr.io/reminder. You can unsubscribe at any time. You just reply stop and it will stop. We don't market to you. Certainly don't sell your info. I am getting a annoying fake calls lately. I will never, ever, ever, ever do that to you, even if we're not friends anymore, like Musk and Trump. Which it's kind of like the parents fighting in front of the kids. I don't want to see this stuff going on between the two of them and all that. It's kind of funny. Also funny to see the reactions of people, but we don't need to go down that road, do we, my friends? So let's go ahead and let's get started. Tell me what we got going on. All right. Yeah, Megan, I was definitely frozen. This computer is having some issues. Let me know if y'all are hearing me now. I think we're all good. We're back to it. Yeah. So stick around. Don't worry, we're back. So anyway, Allison Foy, awesome that you saw the Tech with Moselle. She's a sweetheart. So I wish you were here. Hello, hello, hello. Yeah, right. And frozen again. You know what's happening is the computer is trying to get on the crappy Wi-Fi of the hotel instead of my hotspot. So I think I got it fixed. I told it to stop trying to auto join. Anyway, I'm here. Let's get going. Enough of this nonsense. So sorry, my friends. All right. So quick recap. What happened yesterday? Let me go ahead and show you the screens. We'll get into the good stuff here as I'm showing that to you. So whatever happened on Wednesday wore off. Bonds lost ground yesterday. There were a handful of where is all the market data? Hold on a minute. I had everything all set up. Now everything is foobarred. This is where are my here it is. Okay. All right. And let me see where I'm at so I can move this. Okay. Let's move this screen over to here. All right. We're going to get through this one way or another, my friends. So yesterday was a bad day. If we take a look here, basically this entire section, you could see that we were losing ground. It went down the whole day. It was just a steady downward slope. It kind of looks like we were going snow tubing. Wednesday we had this odd. Remember, this was a big surprise to me. I was not expecting Wednesday's improvements. I didn't call for them. I didn't think we'd see it. When we take a look at the Japanese candlesticks, Wednesday is this green candlestick right here, and it broke above. See the green line and the red line right here? Those are the moving averages. And we broke above these moving averages right here and went into a whole new range, but it didn't last. Yesterday, you could see it's this red candlestick right here that you see, and it broke back down and closed the day down here. So on the red candlesticks, what happens is you're starting the day here, you're ending the day here, and we went down on the day, which of course is not really great for your rate sheets. If we take a look at rate sheets, let's zoom in on this so you can see it real clear. Taking a look at rate sheets, I mean, it showed a little bit of a move. So Wednesday, was 6.87. Yesterday was 6.89. So this morning we get labor market data. And what does the labor market data say? All right. So here's the 5 takeaways. Hold on a minute. I got to change the thing. So rate sheets today are going to be worse. We don't yet have anything to worry about with big sell-offs. Wednesday's rates are all gone. So you can see if we take a look here, Wednesday, we started right here at this point. Okay. And in fact, let me just draw this almost like a clean line if I can. Doing this on my little mouse thing, right? We're right here. We moved all the way up to here on Wednesday, and that's where you saw better rate sheets. Remember, when mortgage bonds go up, that's better for rate sheets. When it goes down, that's worse for rate sheets, right? So yesterday we started to go down and it fell to right here. This morning we started here before the jobs data came out. We're going down and we are just a hair below, if we take a look here, we are a hair below where we were on Wednesday. So all of those improvements that we saw to rate sheets on Wednesday are gone. Instead of being at, say, 6.8 anything, you're going to be back at 6.9 anything. So you're probably going to see a jump over the last couple of days of about an eighth. And that's why I was still locking with Wednesday's stuff and started to float yesterday, because yesterday we did have, when we started the day yesterday, it wasn't too bad. But when we did the show yesterday, we were right about here, right? And, we were like right here, and it just kind of lost its ground through the day. And at that point, it was like, hey, lock it if you don't want to gamble. We needed to see a low number on the jobs data to see things improve. By the way, reprice risk on the day is moderate. It would be the first time that we saw, it wouldn't not be the first time that we saw bonds lose ground and drift lower on a jobs data day. So already losses on the morning based on this morning's jobs data, which I'm going to go over in a minute. So the reprice risk is moderate on that. Let me just see if you guys have any comments. Let me know, by the way, are you guys hearing me okay now that we have the damn thing dialed in again? And let me know, because I'm curious about that. But I should be good. Hopefully we're good now, because we're on the phone Wi-Fi and not the hotel Wi-Fi, which is what was causing all that problems with me being on there. So let me go ahead and get rid of this little bottom third, and I'll throw the Outlook up on the screen. Thank you. And Allison, if you didn't hear me, yes, Moselle was awesome, and I wish you were here too. outlook, more of the same. Rates will continue to hold the current range with small gains and losses in pricing. Very much of what we've seen, right, is kind of what we're going to see. So let me go ahead and put the screen back on, and we'll get into the good stuff here. So taking a look here, moving over, let's take a look at the 10-year Treasury yield and where we're at here. You saw that same behavior. Remember, the yield, when it goes down, that's actually good for us, whereas pricing, we want to go up. So over on this side, when we're here, we want this to go up. When we're on the 10-year yield, we want that to go down. And we took a look here, and we saw it break through. And you know what? Let's even zoom in. Let's do 1 month so we can really kind of get in on this. And we saw it break through the, this 100-day moving average, this green line. And now I'm drawing a yellow line, right? This was a big deal, and it was a very unexpected. Traders were jockeying ahead of the jobs data, but something else had to be happening that we don't know about, because there was just too much of a move here on Wednesday. And then yesterday it came back up and tested that level, right? So when you take a look here, we were testing that, and once you break through one of these levels, it starts out like here, it's resistance, and then once you break through it, it's now support. And then today we just busted right through it. Now, if we had gotten some better news with the jobs data, that would have been different. Let's talk about what the news was for the jobs data in case you haven't seen it yet. So payrolls increased, non-farm payrolls increased 139,000, which really is not a huge number. It's not a big, remember, we've had in the twos, and 139,000 jobs created in May is not a huge number, but it is more than what was expected. Was revisions downward in previous months. And I know, like, we kind of go back and forth on this. I don't think the data is manipulated. I just think the data it's a very inefficient and inaccurate way of getting data. The revisions are basically, they're not corrections. It's basically the including the information that was received over time. Okay, that's what you want to consider this. Downward revisions to the two previous months, 95,000 less jobs than expected. And that's partly what's tempering us from having any huge sell-off. Unemployment stayed at 4.2%, but this is kind of a lie, right? This 4.2% is a little bit of a lie. And the reason that this is a little bit of a lie, what I'm talking about with that, and I'm going to put my face up on the screen too. So let me know if you guys can't see what I see. Do you see what I see? And in fact, I'm going to move this. Well, you won't see it. So anyway, I'll move this over to this side of the screen so that, oops, I gotta get rid of this. I'll move this over to this side of the screen so that you guys can probably see it along. No. Ugh. Sorry. All right, hold on a minute. Let me move this back to its previous spot. Now we're going to take it and we're going to, there we go. Okay. So hopefully you're seeing what I see at this point, and we're all good. So anyway, job growth moderated 4.2%. I was talking about how this is a bit of a lie, right? It's a little bit confusing. It's a little bit of a lie. The reason that I say that it's a little bit of a lie is because the participation rate is down. And the participation rate, you can see here, fell to a 3-month low of 62%. And anybody is saying that the reason we're seeing that participation rate go down is because of the forced the deportation of workers because of all the immigration stuff and illegal immigration. I don't know whether that's true or not, but that's what a lot of this is being blamed on. And the idea is there are a lot more unemployed people, but the participation rate dropped because these people that were participating are now being out of the country. So that's kind of changing that unemployment number. Federal government jobs shed 22,000 jobs, the most since 2020. So we did see the effect of some of the DOGE changes. We've been looking for those to show up on the labor market reports, and here they are on the labor market reports. So Treasury yields rose across all maturities. The maturities mean how long they are. So you got your 30-year, your 10-year, your 20-year, your 7-year, your 5-year, your 2-year. So, that's really, we've seen that across all the board, short-term and long-term. So U.S. job growth moderated in May. The prior months were revised lower, indicating employers are cautious about growth prospects as they weigh the Trump administration's economic policy. That's what they wrote on there. So that's kind of what we're seeing. Next week, let's go ahead and take a look at what we got going on for next week. Let me see if you guys are saying anything here. So let me get rid of my fancy head. We're going to stop screen sharing for a minute. Good morning, Julie Lawrence, Mike Tebow, Karen Cabrera, Glenn Bassar. Great to have all of you here. Let me know if everything's making sense so far, y'all. But basically, now let's look at what we got going next week and where rates are at. So one more time, talk about where rates were, where they are today, where we think they're going to go next week. And overall, I can't stress it enough. This feels like big movement, all of these changes that you're seeing here. But the reality is that they're really not, are they? This is like I'm drawing on my iPad screen. But anyway, I'm not. So we're not seeing big moves. It feels, we're talking going from just about 7 to 6 and 7/8 feels like a huge jump in rates or a huge drop in rates. That's where we're at right now, showing you just how stable things are. Now, we're heading into next week. Next week, we're going to get the CPI inflation report. Let's take a look at the economic calendar to see what else we got going on for next week. So taking a look here with me on Monday, you've got, really not much of anything. Wholesale inventories, consumer inflation, blah, blah, blah. On Tuesday, again, not much of anything. And if the IB's business optimism, 3-year note auction, none of these going to be anything. So far we've got Monday, not really anything to worry about. Tuesday, nothing to worry about here. Wednesday, that's the day that we get the CPI data. So Wednesday is the big money day. The thing is, how much of a big money day is it really going to be? By the way, we also have bond rollover, which doesn't affect pricing, but kind of tweaks the sheets a little bit. That hasn't been that big, though. I'm not going to go into what a bond rollover is this moment. It's just, we're already going to run long with that. But next week, we got the CPI inflation data. That's going to be on Wednesday. Now, if the data comes in showing stronger inflation, what that does is it's going to change the expectation of what markets think is going to happen for rate cuts. So looking here at expectations of Fed rate cuts for June, there is no expectation of a rate cut. 99.9% probability it'll stay exactly the same. Let's go back to the end of the year and see what's happening here. There's still the bigger expectation of 2 cuts. You see that right here. But here's the change from yesterday. Yesterday and Wednesday, we had markets saw weak economic data, and they were like, hey, if that labor market data comes in weak, we think we're going to see 3 rate cuts. We could see 3 rate cuts. Instead, let's go ahead and do the compare feature so you can see. All right, look at the change of what we've seen yesterday. It was right here. Today, it dropped all the way down here. And this is for 3 rate cuts, right? This one's for, you don't really see that one that well, right here, for 3 rate cuts. This here is for 2 rate cuts. This is for 1. This is for 0. All right, so right now, expectations for only 1 rate cut. Look at the jump here. Look at how this has gone so much higher than where it was. This was a week ago. This little line is a week ago. This is yesterday, right? And then today, boom. So that's what you've seen happen. Expectations of 2 rate cuts. Look at how steady that's been. So you've got some bets either way that we're going to see more or less than 2. But markets have been pretty settled in on 2 for a while now. A month ago, though, look at how expectations were so much lower for 2 cuts and so much higher for 3 cuts. That was a month ago. Now you're down to here. So that's really what we're seeing happen there. And that's why things go up and down. So right now, mortgage bonds are up down 23 basis points on the day. Next week, when we get that CPI inflation data, things like that, we could see things continue to get worse. We get jobless claims every Thursday. You've got your producer price index, wholesale inflation on Thursday here as well. And then Friday, we got consumer sentiment. So it's the later part of next week where we could see some moves. I'll tell you, I am not jumping up and down about the reports because I think that we could see. Let me see if I can make this. It won't let me scroll over. So hold on a second. Let me refresh this. All right. Come on, scroll. Do I have to make the page smaller? All right, we'll do that. So that'll work fine. So anyway, I think if we take a look here, we were improving. This was good for pricing, and now we're down. I think next week we could continue to go down. That puts me in a locking stance, my friends, for most loans. I just don't see a lot of merit. I normally don't like to lock on a jobs day to day. Usually you're going to see worse pricing on a Friday. So if we hold off till Monday, as long as things don't get worse from where they're at now, it's not so bad. So if you don't get our text alerts, make sure you're signed up for those, because we'll send out a warning with the text alerts. But you can sign up for our text lock advice at ratetextalerts.com, or use this cool QR code. We send out a morning text, an afternoon text, and then alerts if the markets are moving and reprice risk increases. However, remember this week, reprices weren't really all that prominent. So it's there. Chat is taking up half your face, another half the screen. Oh, the chat takes up. Yeah, I didn't. Yeah. Well, anyway, we're here, y'all. So that's what you got going on. TGIF, baby. TGIF. The good news is, the longer rates stay stable like this, the better it is, because consumers become very conditioned to them. But the headlines are highlighting any small movements. Like, because you get the Freddie Mac survey, there's headlines like mortgage rates dropped, they dipped. Take advantage of that. Get out there and run with that perception, and tell people, hey, let's get you going before things go up. Take advantage of it. So what stuff are you struggling with these days? Let me know in the comments what you guys are struggling with, and I will I'd like to know. So in the meantime, thanks again for joining me. Appreciate y'all. I am still here in Atlanta. Much prettier day today, though, than yesterday. Take a look here. Here's the view. I am at the just a loft. I'm not in the fancy hotel that they're at for the event. Not spending, I wasn't going to spend the extra money to be there. It wasn't worth it for me for this one. So, but anyway, hope you all are doing well, and you guys have a fantastic weekend, and I will see you on Monday. All right, everybody, take care. Make it a great one. Thanks again for being here. Bye-bye.